Do we have more pain ahead? And if so, when is the bottom of the stock market gonna actually come? This chart right here explains a lot on prior bear markets and when the bottom actually came. But before we actually jump into that, guys, first I want to talk about interest rates, layoffs, and the looming recession and how it all leads back to when the bottom of the stock market will come. So definitely stick around to the end of the video. If you like what I do here, definitely hit that thumbs up button as well as subscribe to the channel. If we rewind back to 2020 to 2021 when the Fed was printing trillions of dollars injecting into the market to stimulate it during the pandemic, companies were greatly benefiting from this stimulus, making their all-time high profits. They needed to hire tons of people to satisfy this new demand. Wages were increasing, and those that got laid off from their jobs also got some nice fat stimulus checks from the government. At this time, home prices were at an all-time high, Bitcoin was at an all-time high, and so everyone felt rich. When everybody feels rich, they buy new cars, they buy nice furniture, they buy new clothes. Companies need to raise prices in order to keep up with demand. When prices of just everyday objects such as going to the grocery store get way out of hand, this is what we call hyperinflation, which is what we're going through at the moment. In order to combat this hyperinflation, the Fed needs to do the complete opposite of what they did in 2020 and 2021, which is suck the money back out of the system by raising interest rates. And that's exactly what we saw in March of 2022 with the Fed starting to raise interest rates to combat inflation by 0.25 basis points. They began to raise it again March of 2022, so keep that date in mind, guys. And in May, they raised it even more by 0.5 basis points. In June, they increased it to 0.75 basis points, and they kept that also into November at 0.75 basis points. And last December, they only increased interest rates by 0.5 basis points. So they're still raising interest rates, but not quite as much as before. And in just the next couple of days, guys, Wednesday of this week, the Fed is likely to raise interest rates again by 0.25 basis points, but we'll see until then. And as I mentioned earlier, when the Fed prints trillions of dollars to stimulate the economy, everyone feels rich. So the complete opposite happens when they start to suck money out of the system by raising interest rates. People begin to feel poor. Companies take a major hit on their current and future profits. The demand has dwindled, and so they start to lay off employees. We've seen it already with Google laying off 12,000 employees, Microsoft laying off 10,000 employees, Amazon laying off 18,000, HP laying off 6,000, Meta 11,000, Twitter 10,000, and just to name a couple more, Cisco 4,000, Philips 6,000. Along with all these layoffs, when the Fed began to raise interest rates, this started the fall of stocks and crypto from their all-time highs, entering into the bear market. But even after this major fall that we've already seen for stocks and crypto, it's really just the beginning due to the lag effect.
There's a serious lag in the market. Remember, it's always 12 to 18 months, and that 12 to 18 months could happen at any time, right? The lag right now is people still have savings. You haven't seen people lose their jobs. You haven't seen companies lose their jobs. We haven't even started to see the effect of that. When you're going to see the effect of that is when people are going to be losing their jobs.
When the Fed increased interest rates, it doesn't necessarily have an immediate effect on the economy. There is a lag. The lag tends to be about anywhere from 12 to 18 months. So when they start to raise interest rates, 12 to 18 months after that is when we feel the full effects into the economy, because it just takes a while for the money to start getting sucked out of the economy, because the economy is a pretty big place. So even with this downturn we've seen already with stocks as well as crypto and all the layoffs that has announced since, we still haven't even felt the full impact of that very first 0.25 basis point hike that we saw in March of 2022. So if it's 12 to 18 month lag, therefore we're only gonna feel the full impact of it somewhere around March of 2023 to September of 2023. So heading into the middle of 2023 towards the end of 2023, it's not looking very good. Stocks and crypto might fall even further than what we've already seen them fall at. Layoffs might happen even outside of the tech sector, increasing unemployment to where maybe the government will begin to announce a recession.
As the Boston Globe pointed out, throughout the last 6 recessions that have already been confirmed, there's an average lag time of 7.3 months between the time a recession takes place and the time it's actually announced. Why does it take so long, you might ask? ask, well, in their 45 years of operation, they have never once had to rescind one of their declarations, which means they're extremely accurate and that information usually takes about a year to confirm. That means we usually only know about it once it's already behind us.
And so the Fed made it very clear that they're not going to lower interest rates all of 2023. Many are expecting the Fed to begin to lower interest rate, pivot, start printing money again sometime in 2024. And like I said earlier, when the Fed begins to print money again, injecting into the market, people will begin to start feeling rich, but it's not going to happen immediately. With the lag effect, not only does it affect the interest rates going up, but also with the interest rates going down. So there is going to be a lag, which brings us back to this chart from the beginning of the video. I really like this chart because it mentions what happened in the past once the Fed pivots. So in 1960s, the Fed pivots, and only later did the market fall 36%. And in 1970, the Fed pivoted and the markets fell soon after that, 48%. And another pivot happened just years later, the market fell 27%. In the 90s, the Fed pivoted and it dropped 51% soon after that. In 2000s, the Fed pivoted and the markets fell another 58%. And in the most recent example, the Fed pivoted and markets fell 35%. So what I learned from this chart is that in previous times when the Fed pivots and begins to print money again, it's only later does the bottom actually come. And of course, at the bottom, that's the best time to jump in, get a position, buy, and just sit and wait until the markets begin to start rallying up to all-time highs. So the plan for 2023 and 2024 is to really save up as much cash as I possibly can, also make as much as I possibly can, and reduce my expenses as much as possible. You know, with all of this going on, you know, unpredictable times during a rainy day where I might get laid off at my job, I'll at least still have a backup plan to where I'll be able to pay my bills. And even better than that, you know, if an opportunity comes up, such as Bitcoin hitting, you know, sub $10,000, that would be a great time to jump in and buy some Bitcoin. As well as if the stocks fall and bottom after the Fed pivots, just like the chart, it'll be a great time to jump in the market and buy those stocks at a very cheap price and ride it all the way up. You know, but until then, with all the cash that I'm saving, dollar cost averaging, not as aggressively as I used to, and also putting it into a high interest savings account, gaining about a 3.8 annual yield. All right, guys, that is the plan. If you like the video, definitely go ahead and hit that thumbs up button. Also subscribe to the channel. My name is Jimmy Invest, and I'll catch you in the next video. Peace.